All right. Welcome back to the Educated Homebuyer Live, where our goal is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. With me once again, Mr. Josh Lewis, our resident mortgage professional. Are you a
Resident
resident now
because
of
I
the
never get to
podcast?
leave the office. I get to stare at the computer and talk at all times.
Josh is having a hard day. So you guys
Weak.
need easy questions tonight. Don't make him use too much brain power. He's struggling. He's having some emotional breakdowns earlier in the day.
Jeb had to talk me off the ledge a few minutes ago.
Anyway, we appreciate you being here. If you're new to the show, this is where we answer your questions live. I know a lot of you guys listen on the podcast and are asking, wanting to see the show. This is the show. This is where we answer the questions live, and then we take that show and put it on the podcast on Friday, in addition to the episode that we film or record on Tuesdays, rather. But what has happened from last week to now? Rates continue to move a little bit higher, which we're going to talk about in more detail here in just a moment. We've received pending home sales, which came in, no surprise there. We knew we were going to see a jump in pending home sales just because we saw that drop in buyer demand, towards the beginning of January, and that spurred, people out there wanting to buy homes. And because of that, we've seen that jump in buyer demand. And we're going to talk about what I'm seeing out there as an agent right now with regards to working with buyers, what I'm seeing. I put a poll on my channel this past week asking the question of what you're seeing at open houses. And I actually need to go back and look at it, but the majority was about split. About half of the people were saying little to no activity, and the other half were saying better than I expected to a little bit busier. So we're going to talk about that in more detail. But while we do that, Josh, why don't we talk a little bit about interest rates here and get things moving in that direction?
Yeah, you want to let's throw the slides. It's a
Yep.
little bit helpful here. We'll get back here.
Yeah, we'll start there.
So
Yep.
look at this. This is a 30-year 5% mortgage bond, and you're probably saying, "Well, rates aren't 5%. Why is that?" It's a toss up between the 5 and the 5.5% coupon, which is better to look at right now. But this gives us a view back to September. So we've kind of made a round trip here. We went all the way down. So remember, Jeb always likes me to point out down is bad in this because that means prices paid for the bonds are down, interest rates, yields are up. So we hit what looks like the 20th of October or so, kind of the worst levels, and then improved and then kind of backed off and then improved and backed off. I drew that red line in there. That red line is a pivot. And if you'll see the red candle on the far right, we kind of gave up that line today. So barring a turnaround, it looks like we're going to move lower in prices, higher in yield. So any of you who are in contract now, who are going to be closing in the near term, probably better to go ahead and get locked. There are a lot of conflicting signals. We've talked a lot about the things that are good and likely to help improve rates going forward, but we also week by week kind of get surprised by stronger than expected numbers. Jeb, here you threw in the chart. Mortgage News Daily says 6.94. I think rates are a little bit better than that. That's a pretty good industry-wide average. And a lot of times, we get jaded here in California. Our loans are so big and there's a lot of competition. So the pricing's a little more razor thin in terms of margins here because of the large loan sizes and the amount of competition. If you're in Nebraska and average loan size is $200,000, $220,000, pricing won't be quite as good. So that 6.94, we're hanging on just under 7%. And it doesn't look super positive here in the short run of the direction that we're going to be going. I threw up a couple pieces of information. So one of the things, Jeb, that we had been talking about the last few weeks is we were going to get PCE last week on Friday. The hope was that PCE would be a little bit improved because it doesn't weight housing expense quite as heavily, and it didn't have the seasonal adjustments that we saw in CPI. And we didn't get that improvement. So a couple of the slides that I have here are elements of what was reported there. This chart here is real personal consumption spending. So real, when they mean real, they don't mean did you really go out and spend the money? They mean this has already been adjusted for inflation. Now, I don't know about you guys. We come here every week. We look in the comments and everyone talks about, hey, I'm tightening my belt. I'm not spending money on this. And yet what we see here the average consumer is spending more money than they were after adjusting for inflation. So it's not just that prices went up because of inflation. They're literally spending more.
Well, Josh, while you're on that, I don't know if I talked to you about this or someone else, but kids are on spring break here in a couple of weeks. And so family, we're looking at doing a vacation for when they're on spring break, trying to plan something. Guys, booking a vacation, for one, super expensive. It's crazy what flights cost these days, what it costs to stay in a hotel. Like I remember, and I'm not trying to date myself, but I remember like you used to be able to get a really nice hotel room for 450 bucks, right?
Like
Not
really
anymore.
nice, really nice.
Now it's $700-800 a night for a mediocre hotel room in a lot of these places. And we're looking at booking, vacations and what have you. We had to book 2 months ago to get something that, is solidified that we're going to take in April. Whereas we used to be able to book this, say, now and do it just because, there wasn't that many people. There's so much demand out there. There's a lot of spending still happening. So it just kind of corresponds exactly with what you're saying there, Josh.
And that, I mean, Jeb, that truly is inflation. That's the same thing going up in cost. Once it's adjusted for inflation, who knows? Who knows if people are actually spending more on things of that sort? But anyone talks about what is the big topic that came up this week? Revenge vacationing. We've been trapped at home for 3 years, so everyone is going on vacation. Flights are really expensive. A number of things expensive in cost. So these got kind of mixed up and out of order. But again, from last week's report, year-over-year change in personal consumption expenditures in the price index. So had peaked and is moderating, but now we're just kind of going sideways here. And we're well above the Fed's 2% inflation target. So we've shown the Fed funds futures chart that keeps slowly pushing out the expectation of Fed cuts to the end of the year. And I think we're close to having given up on that idea. We're in the beginning of March here. So it's going to be 2-3 months before we see anything that resembles confirmation of what they're wanting to happen. And they want to keep rates elevated there. So again, in terms of mortgage rates, the thing that's important to remember is that mortgage rates don't follow Fed actions. They follow the direction of inflation. The Fed actions were caused by the direction of inflation. It was high and rising much faster than they wanted to. So they were hiking. Eventually, they're going to stop. It looks like we've got a quarter again, possibly another quarter.
Yeah. So I just shot a video today, in fact, talking more about inflation and what have you. And at the moment, latest, predictions push essentially 4 more cuts out there are priced in, taking us to almost
4 more hikes.
4 more hikes, rather. Sorry, not cuts. Taking us to 5.5 to 5.75. The last one, it's only like a 40%, probability at the moment, but it's priced in, whereas before it wasn't priced in at all. And still, like you said, the rate cuts starting in December are still priced in. So it'll be interesting.
Which that one, I'm like, why would they cut? They
seem to think that there's something big is going to happen recession wise that would cause them to do something different.
So think about that. There would have to be a big negative shock. So far, the economy has been surprisingly resilient. Some of these numbers don't necessarily make sense to us with what we're hearing and seeing on the street, but the numbers come out just slight upside surprises across many different measures. So for the Fed to cut, it's going to require a big downside shock. I don't see where it's coming from. I think they're going to stop here sometime middle of the year, but likely keep rates high and at this level for a while. Now that doesn't directly spill into mortgage rates and tell us where we're going. That will be the month-over-month inflation measures. Jeb, what will be interesting going forward this month is, do we keep focusing on CPI or does that shift? Now we saw some trading off of PCE this month, which was the first time in a while. Maybe it shifts over to where they go back to the Fed's preferred measure and look at PCE.
I don't know, man. There's just so much hype around the CPI number. I don't know if they can just change all of a sudden, but we'll see. And we're going to talk a little bit about inflation here in just a moment, but we're going to look at some other charts as we always do. Inventory, once again, guys, down another 1.5%, sitting at 429,757 nationwide. The lowest numbers we've seen in a very long time. Here in Huntington Beach, sitting at 148 properties, Orange County, 2166. We haven't seen these numbers since, I don't know. early fourth quarter of 2022. So it's been a while. Inventory is going the wrong direction to give buyers an opportunity to bring prices down in any significant way. You need more inventory to come to the market, which we talk about every single week. And on this topic, let's talk a bit about a couple of offers put out. So put out 3 different offers in the past 8 days, 7 days. And all 3 of them are multiple offer situations. One is somebody we've been making offers with for the better part of a year. He stopped and came back to the market now that rates are double. Decided to buy now when rates are significantly higher. But nevertheless, he's back in and always making strong offers, always at the asking price, above the asking price. But during the heyday, if you will, of the market last year, unwilling to go crazy above, and therefore he never got a property. So now he's coming back, making offers at the asking price, a little bit above. And the property that he purchased or was looking to make an offer on was listed at $1 million. He offered just over $1 million. I think $1,010,000 was his offer, and very strong, shortened contingencies, did everything right in the offer. That property ended up having 15 offers on it, 5 of which were $100,000 more than the asking price. So over 1.1. So 5 people offered $100,000 more in a declining market that's crashing. Right? That was a sarcastic remark there. Didn't really come across well, did it, Josh? No. Secondly, offer in San Juan Capistrano, listed last Friday, put an offer in on Sunday, had multiple offers on Sunday already. And as of today, they're still taking offers for whatever reason. So there's that one. And then another buyer, actually one of the buyers that wrote an offer on that, made an offer last week, multiple offer situation, and they went with one offer without countering anyone. So out of 3 offers, we got nowhere on those 2 different buyers there, and all sold for more than the asking price in a market that supposedly isn't doing anything. So just know out there, guys, it's not, nobody's giving away houses. If you're planning to buy, you just need to plan accordingly and kind of have an idea of what to get into. I was surprised to see people going well above the asking price on that particular property. For one, it seemed to be priced right at its current price. And so really surprised to see where those numbers went. I don't know. It'll be interesting nonetheless. So
Jeb,
that's where we're sitting.
I think we talked about it last week. I have that client looking out in Wildemar, and again, he wanted something unique. He wants acreage, so he got a half acre. He was offering on the property. It was a half acre. It was a manufactured home. He lost out. I don't know how high it actually went. He went $31,000 over list. It was listed for $430,000. He went to $461,000 and didn't get the property. So there doesn't necessarily seem to be rhyme or reason, other than the ones that are getting that kind of bidding that I'm seeing. There's something unique about them, that there's a bigger bidding pool, but still not really seeing anyone getting, huge discounts on properties either.
No, understood. Let's see here. Next chart. Also, weekly inventory coming to the market. I like this chart because you can kind of compare it back to, this time last year to see where you were. So if you're going back, looking in early part of January, inventory was coming to the market at a quicker pace than it is at the moment. But we did see a couple of weeks there where inventory went up and then kind of went back down again. But then we started to see mid-February was really where we started to see inventory kind of go up and up and up. This time, we're starting to see the beginning of February. We're nowhere near the numbers that we saw last year. It'll be interesting to see if March, brings more inventory, because we're not seeing it come on anywhere close to to where we did last year. Price reductions looks to be moderating a little bit. Price reductions have come down. We're sitting around 40%. Only 31% of sellers are out there having to reduce prices at the moment. A lot of that had to do with interest rates coming down, buyers coming off the fence and buying property. But that line looks to be flattening a little bit. I think if interest rates stay where they are now and properties, are there, sellers need to sell, you're going to probably see some more price reductions have to come to the market if they are not priced correctly to start. Interesting chart here, just showing resale home purchase contracts receiving multiple offers. So last year, looking at, what is this? I can't see on that. So, January of 2022, 60% of the homes were receiving multiple offers nationwide. Only 25% are now, but 25%. So 1 in 4 is receiving some sort of multiple offer. And depending on where you're located there in the country, you can kind of see the different chart.
And Jeb, I don't know where this fits in on that, but most of the clients that I'm dealing with, they want, like we're saying, the ones that are getting overbids, they have something unique about them. Either they're really nicely upgraded, they're a fantastic location, they have more land. Most clients out there are going after the ones. That's why they're getting multiple bids. They're generally the unique higher end, not higher end in that you're Beverly Hills, but in any city, there's different cities, different neighborhoods, different schools, properties. And for whatever reason, most of my buyers are more attracted to the ones that are going at a premium still.
And I think it's important to note, guys, that when the 2 buyers that I was talking about a moment ago making multiple offers, putting a lot of money down. One of the buyers we're closing today is he's buying a 600 and what's the price of that property, Josh?
640?
640-ish. And he's putting about half down, 50% down,
55% down.
Yeah. So huge down payment. So if the market goes down a little bit in value, it doesn't matter, right? I mean, he's there. He knows, the risk. He's there long-term, what have you. The other 2 buyers that I'm working with, one's putting 30% down on $1 million purchase. That's $300,000. The other one is 18% down, somewhere around $1 million. So, people are probably watching this going, well, what if the market moves, goes down? These people are underwater. No, they're not, because they're putting a significant amount of money down. And most of these people understand the risk that are associated with buying a house in this market, or in any market for that matter. But earlier, Josh, we were talking about inflation. Why is inflation still coming in a little bit higher than expected? Well, this is rent and shelter numbers. Both are reporting, basically the core and the headline numbers are reporting significantly higher than they were in December. In fact, both of these are record numbers, which is coming into the inflation numbers, which is why inflation is reporting higher than expected. Now, with that said, we know rents are coming down. There's a lot of charts out there that show that rents are coming down. They just haven't been reflected in this data, right? Because how rent is reported is a landlord, is typically under contract with a tenant for 12 months. At which point the end of that contract ends, they can adjust prices and what have you. It takes 12 months, 4 quarters for that to reflect in some of this data, which we're not seeing here at the moment. But as that number starts to come down, you're going to see inflation come down. This is another chart looking at the CPI annualized over 3 months. You can see core goods is actually negative. Services minus shelter, so excluding shelter, is actually below that 2% target, where shelter is the one that is pushing inflation higher.
And Jeb, when you said rents are coming down, it's not that rents are coming down. Rents
not
are
coming down.
Going
They're
up at a much
Yeah.
slower pace.
Yeah.
They were going up rapidly, and that was very problematic for anyone. That's most of us, even above and beyond a vehicle. I mean, we talk about the number of people with $1,000 or higher car payments now is an all-time high. But even at that, rents are well above that. It's the biggest portion of your income. So if you pay $2,000 a month in rent, it goes up 10%, it's $200. So it's a significant amount of money. There's no sense, Jeb, for us in talking about it for those that are still renting at this point. But in 2015, 2017, 2019, 2021, we're saying you should be fixing your housing cost. That's the reason for that. Even in 2020, 2019, if you had bought in Southern California with 3% down, 5% down, your payment would be more than it costs to rent that property. But we talk about all of the benefits and advantages that you have there. Now, after 3-4 years of large rent increases, rents in total are probably up 20% in that timeline. People that bought in 2019, 2020, even with minimum down, probably had a chance to refinance, get rid of mortgage insurance, lower their rate, or add a much lower payment. So the past doesn't always equal the future, but we've historically seen that you have an opportunity over time to lower your housing cost when you own, whereas a renter is always subject to increases over time.
No, absolutely. In fact, the latest comment just came in here. We keep hearing a lot about the Northeast markets and how they're just crazy hot. Harriam comes in and says, New Jersey market, crazy hot, 550,000 asking. Someone got 700,000 all cash, took the property on the second day of listing. So guys, when we talk housing, we're talking locality to some extent, right? All real estate is local. What we know really, really well is Southern California real estate. We don't know New Jersey real estate really well. We don't know Florida real estate really well. We know Southern California real estate. So when we talk, a lot of the examples that we get are around Southern California real estate. Now, I'm not in any way telling you what's happening in Southern California is happening everywhere. But what I do, what I can say is that in talking to a lot of agents across the country about different markets all the time, I know that our market is similar to a lot of other markets out there. And so, we're here to provide that information for you. You got to make the best decision for you, where, depending on where you are in your life and what have you. So we're sitting low inventory. Rates were lower. It spurred buyer demand. We got a lot of people off the market and things moving. Now their interest rates are a little bit higher. It'll be interesting. The next couple of months are going to be interesting because I don't think you're going to see a big move in rates until probably May, just because of how inflation is reported, just waiting on some of these things to actually click into the data and show. So that's the end of the spring selling season. And typically a time you're pretty close to where you would normally see the peak in inventory for the year. And so it'll be interesting. Are you going to see a lot of properties flood to the market? Or do we have this gridlock that Josh and I keep talking about and trying to figure out how it solves itself, where sellers have super low rates, aren't going anywhere because why? Why do I need to sell my house when I have a 3% interest rate? And then, and looking at higher prices in most of the nation. So
Jeb, let's look at that, what you just said from a slightly different angle. You said gridlock. I was listening to Scott Galloway's podcast. They go through different financial news. He was talking about housing, and he was talking about two different markets. I believe either in Colorado or Florida, he's looking for a second home. In that second home market, 60% of the homes are being paid for with cash. And then you look at, he flashed over to another account or another area, and entry-level buyers, like, you just can't qualify. So he was calling it a stalemate. He says, I feel like right now we have a stalemate between owners who don't want to sell or don't want to believe that prices are lower or that the peak value isn't what the home is worth. And then we've got people that are renters and that want to enter the market, that want to own a home, and they are hoping and expecting a crash. And we have a stalemate. And I'm listening to it and I go, there's absolutely some truth to that. We talk about this every week, but that inventory number tells us it's not a stalemate. They're not putting a sign in the yard and saying, hey, I'm going to keep it out there until someone pays me my price. They're literally just not putting a sign in the yard. They're saying, I don't want to try in this market. I'm happy with where I'm at. Jeb, you and I, we've talked about this on the show. Neither one of us would say our homes are our dream homes, but they're pretty darn nice. So in with the current status, there's zero reason to move. And I think a lot of potential sellers look at it that way.
My wife disagrees with you.
Your wife says, Josh, you are wrong, and stop talking.
My wife she sends me a property every day. So who knows? I'm surprised I still live where I do, just because of that. I'm going to put up a chart here just because you said something that made me think, Josh, while we're talking about this. And for those of you who listen on the podcast, I apologize because we show some of this stuff and then you can't see it. But you just said something. You said 60% of the people buying homes in Colorado are paying them in cash. This article came from, I forget which news source, but basically says that all cash deals share above 50% of the market share in 13 cities, Atlanta being one of them. So there's a lot of cash out there, guys, of people. That's who you're competing against in some of these markets. Now, that's not everywhere, but in some of these markets, because people sold, they're sitting on money, they're waiting for these opportunities. That's some of it. Some of them are investors, although the investor share has dwindled a bit based on recent reports. But it's not just all people financing property. And I think that gets a bad rap because people are like, oh, he's buying a property now, they're financing it, they're going to be underwater. No, they're not, especially if they're paying cash. So Josh, this is where we are. We're 24 minutes into the show. We haven't answered one question. Do you want to answer some questions? do you want to answer some
It
questions?
is
We don't
kind
have a
of,
lot, quite
it is
frankly.
kind of, we don't have a ton. We have a lot of comments, not many questions. What I will say before we jump into that, Jeb, we have the comment here, someone talking about New Jersey and what the New Jersey market is doing.
Yep.
I hosted the Vetted VA Live last night where we talking about how to get a VA offer accepted in this market. And that conversation was, again, about how to get an offer accepted, because it is not easy. You know, everyone wants to think, hey, home prices are down, sellers are just begging, waiting, hoping for an offer. That's not the case. But more importantly, we had a gentleman from Florida, and he said it's a pretty balanced market there. It's not super strong seller market like we had, not a buyer's market by any stretch, but definitely not that strong seller's market that we had. Realtor from Maryland, she said it's nuts everywhere, all through her market throughout the state of Maryland. Multiple offers, bids above ask, more so than I had heard from most folks. And then had another lady, loan officer in Maine, and she said it's a pretty solid market. Most of my buyers are going up against other offers. I'm not saying it's the 10, 20 offers and massive overbidding. So like you said, we're not experts in all markets, but we do talk to a lot of people, and it's interesting getting a feel for different markets. It's sometimes surprising. Like, I was somewhat taken aback that Maryland would be that hot. It's hotter than what I'm hearing from almost anyone anywhere else.
Yeah, but you got to think of where it's located, right? So the DC market's always been like a super hot market, Northern Virginia area, and then Maryland, obviously being a close second to that market there. There's a lot of government, a lot of just people. It's kind of a tightly knit, like little packed area there with a lot of people, kind of in between what the South and what most people consider the Northeast. So I see it. Richolas Cage has a question. Says, I had an independent home inspection completed on a new construction under contract. How should I address the issues with the builder that the inspector found? So here's the thing. Typically, if you're buying a house, you have an agent representing you. Your agent would normally have a conversation with you and say, okay, what in here concerns you? What do you want addressed? What do you want fixed? How do we want to, basically go about this? And put that in writing on what we call a request for repairs. And we would send it to the listing agent on the other side. With a builder, you might not have an agent. You might be working with the builder directly. Now, if you have an agent, your agent can do the exact same thing that I just mentioned. If you're working with the builder, you have a representative with that builder that should be representing you. Even though they're representing the builder, they should still be representing you, that, where you can bring these issues to them, and then they should be addressing them, putting something in writing and putting it to whoever can address those issues. Chances are the person that you're dealing with isn't the decision maker there, right? So there needs to be something put in writing and put in front of the person that is actually making the decision to decide how they want to move forward. With new construction, I can tell you that it should all be taken care of. These people have on-site contractors. They have people, tradespeople that they've been dealing with that should be addressing this stuff. So I would find it I would be very surprised if the builder didn't just take your punch list and deal with it quickly and get you moving on, because essentially they have people that should be dealing with that sort of thing. All right, Josh, we have somebody asking about the 10-year. John is saying the 10-year is over 4% again. How high do you think it will go?
I would be surprised if it went higher than it did last year, but I would also say I wouldn't be shocked. Normally, I follow people that are technicians and track this stuff very closely and have a better handle on it. But it looks like we peaked somewhere 435-ish. I think we stay below that. But if I remember correctly, the next real technical support, if we gave up 434, 435, is somewhere around 460-ish. And I would think that would hold. And what does that mean for mortgage rates? Well, it can mean a lot of things. We showed the chart a week or so ago that things were moderating in terms of the spread between the 10-year and mortgage rates, normally somewhere between 1.7 to 2%. So say 2% and a 4.6 10-year would put you at 6.6. Well, we're already above that. So the spreads could moderate and mortgage rates could stay the same, or we could see what we've seen here over the last year or two with a 2.3, 2.4, 2.5 spread, and a 4.6 would get you up well into the 7.25-ish at that.
All right, there you go. Joyce asked the question, is it possible to get another mortgage loan if you're assuming the existing VA loan from a seller? The second loan would allow the seller to restore their full VA loan entitlement.
Before we answer the question, Jeb, let's dispel the myth here. The second part is absolutely not true. The second mortgage would get them their equity out of the property. The only way to restore their entitlement is to pay off their VA mortgage. So if you assume it, you're not restoring their entitlement. I shouldn't say that. If you are also a veteran, you can assume it and replace their entitlement with yours. But if you're a non-veteran assuming and not paying off that loan, we are not going to restore their entitlement. Now, that does not mean that they can't use their VA loan again. It means they're not going to have full entitlement, and they may have to make a down payment depending on where they're buying and what that price looks like. But the big question here, is it possible to get a second mortgage if we're assuming the VA loan? So let's say 5 years ago, a veteran pays $500,000 for the house, zero down. They've paid it down to $470 in those 5 years, and you want to buy it from them for $600,000. They've got $130,000 of equity in there. Can you get a second mortgage and assume their first mortgage? Yes, you can. So benefit there, you're going to get their awesome low interest rate on the first mortgage, and then you're going to pay a higher rate on the second. You got to look at your blended rate. It can be an awesome strategy. We just wanted to be super clear on that you are not going to be restoring the veteran's entitlement unless you substitute your entitlement or pay off their loan.
All right. Alex has a question of, are we worried that people are still willing to go over the asking price? Are we making the situation worse? I say, am I worried about that? I'm not worried about that, just because I don't think it's going to be nearly what it was last year when all that was happening, pushing prices up way too fast. It's always been a part of the market forever. There's always been, opportunities where there's been multiple offer situations. Someone's had to go above the asking price in order to make a deal happen. And I feel like for the right property, for the right, the person making that, if that's the right property for them, yeah, if going above the asking price is what you want to do and you're comfortable with everything associated with that, why not? I mean, if I found a house now that worked for me and, I needed to go above the asking price to make it work, it's just part of the deal. Now, if everybody does it all over the place, across the country on every deal, yeah, it's a problem, but I don't think that's going to happen. Jaden has a, very profound thought here for us, Josh. If you were 18 again, how would you get started? Would you marry Angela?
Twice. That's the best decision I made. That's the only decision I never doubt ever at any point in time. Everything
if
else
you were
gets
18
double
again,
doubted.
how would you get started investing with the current market? 18.
Well, let's hold on. I'm trying to get to the actual comment because someone, an answer here came from a listener, a viewer, says, I'd invest in dividends and a Roth IRA. I actually corrected that there, but then also followed up. I really liked what the answer was. He said, hey, I started out with $1,000 and then was adding what I can add to it every month. It sounds insane, but one of the reasons why home ownership works is it is a get rich slow scheme. You buy, you make your payments, and in 15 years, you're like, wow, my payment's really low relative to rent. Wow, that $200 or $300 a month that was going to principal is now $600 or $700 a month going to principal. Investing is the same thing. If you're 18 and you can start with $0 and save $100 a month, it doesn't sound like a lot. It's $1,200. And you say in 12 years, it's $15,000. But you should get a return on that. And then the return starts generating a bigger return. And you're only 28. By the time you're 38, there's $75,000. You're 48, there's $225,000. So the key is just getting time on your side. If we're talking specifically about how to get into real estate, real estate's tough for an 18-year-old. You don't have a work history. Now, Jeb, an interesting thing, a funny question we always get, and it's usually in relation to college, saying, hey, just got a job. I make $80,000, but I've only been on the job for 2 months. I got my degree in June and it's August and I don't have the 2-year history. Well, your employment history can be comprised of your education history. So we can show you were in school for 4 years, getting educated, got a degree, and now got that job. Sounds crazy, but you can do the same thing with high school. Many jobs, you need a high school diploma. So if you get a job that makes $30, $40 an hour straight out of high school, good for you. We can use that. We can show you're in school full time. You got this job. We have a 2-year work history. So I kind of went off track there, but depending on where you're at, you may or may not be able to qualify for homes in your area. Some parts of the country, you can get a starter home. Jeb, we talked about the one that you found, 18 months or so ago, a nice little house in Arkansas for $120,000. You might be able to buy something like that if you're there and can own or occupy. If you want to invest in that single family is going to require at least 15% down. So if you were insistent on becoming a real estate investor at 18, my gut tells me it's going to be some type of creative real estate where you're taking things subject to, you're doing all-inclusive trust deeds. So it's kind of hard because we're saying, hey, you're a beginner and a novice. How do you get into something? Well, the easiest way is to go to the advanced topics and dig into some of the stuff that they cover in depth on Bigger Pockets, where you actually can get into homes without using your own money and qualifying. It's just not quite as easy.
Yeah, everything Josh said is definitely true. I mean, I would just leave you with a quote, a thought, something I have plastered in on my screen here in the office, and it basically says, "We overestimate what we can do in a day, but underestimate what we can do in a year." But I would ask you to change those, the narrative there a little bit, and just say we overestimate what we can do in a year, but underestimate what we can do in 5, 10, 15 years. Like Josh said, like just getting in. Everybody wants to be rich today. Everybody wants to be the investor that has 100 properties today. Start investing, starting putting a little bit of money away. Like somebody said, it doesn't need to be $1,000 a month, maybe $25. Just start putting some money away so that you have something, so that when the opportunity is there and you're ready, you have the money to be able to make that move, and you're not scrambling on trying to have, figure that out. And think long-term. Real estate, like Josh said, get rich slow. It is thinking long-term. And I'm not thinking about the idea of it being worth a lot more, but just thinking about paying it down and going through that process. It takes time. And with that said, you can put yourself in a very good position by starting at 18, because most people don't.
It gives you, think about that.
You
What
have
happens?
a huge advantage.
If you can double your money every 10 years, every 15 years, starting 10 years before most people start, get you one more doubling at the end. You should end up with double the money of the person that puts off starting to save 10 to 15 years, even if you're saving a relatively small amount.
Good. Really easy question to address here, Josh. Going to throw this up there. How many times can I use an FHA loan?
No limit whatsoever. I actually had a listener to the show that we helped buy 18 months ago, 24 months ago, and reached out and said, hey, I would like to buy. They bought with a conventional loan. I want to buy FHA. So FHA has one weird, quirky rule. You can have 2 FHA mortgages at the same time, but if you have an FHA mortgage and you're not going to sell or refinance out of that before you get the new FHA, you have to be moving 100 miles or more away to use rents from the departing resident. So let's say you bought your house for $300,000 with FHA financing. You now want to rent that out because the rents will cover the mortgage and go buy another house FHA. To use those rents to offset the mortgage to help you qualify, you have to be moving at least 100 miles away. But in terms of if you pay it off, if you sell that house instead of renting it, can you use another FHA loan? Absolutely. You can reuse it as many times as you want. You can have multiple FHA loans. They just have to be owner occupied and they have to be more than 100 miles away from the last one.
All right. Kim has a question. Where do you see cities that have the most filing foreclosures happening right now? Honestly, don't know. I haven't. Foreclosures aren't really a big thing at the moment. Not really a lot of them happening. You can go to Black Knight, search Black Knight, and go to their data report. It'll show the 5 or 10 cities or so that are, the most likely to have negative equity, and which in turn leads to more foreclosures and what have you. But right off the top of my head, I can't think of a place where I'm seeing a ton come to the market. Josh, anything ring a bell?
No, nothing. But what I would say is Kim's been here repeatedly, educating herself, asking really good questions. I think the question behind the question there is, where are there some foreclosures where I could possibly get a good deal? I would push back against the logic there. It's intuitive on the surface. Hey, if I can find a place with foreclosures, I can get something cheaper. If a market starts to have a preponderance of listings being foreclosures or more foreclosures than the market can easily absorb, you're probably looking at that market going to continue to go down. It's not stabilized yet. So unless you really are coming at the end of a wave of foreclosures and feel like you can pick the bottom, I would be super careful about looking at foreclosures. Right now, with the current very low levels of foreclosures, it's just other inventory. So we have low supply. Some of the supply is foreclosures. There's a lot of demand relative to the amount of supply, and therefore they're selling for market prices. You're not really getting any discount from foreclosures. And it's not because they don't exist, because there just aren't enough listings, period.
Good. That's good. Good thought. Dina asked the question of, is there a potential that the government will intervene again like they did during COVID that caused rates to decrease significantly? Here's the thing, Josh, I think a precedent has been set to some extent that the government will bail you out. And it's not a good precedent to set in any way, shape, or form. Now, does that mean they'll do it in the future? No, it doesn't. Does it mean there's a likelihood they'll do it in the future? Not necessarily. Does it mean there's a possibility? Absolutely. If you would have asked me 4 years ago if the government could shut down the entire economy, send everybody checks and I would have said no chance. There's no way that can happen. It happened. And here we are today, right? Having this conversation. So is it possible? It's definitely possible. I just don't know what the likelihood of that happening again. I think it's low. I hope that it's low. But Josh, what are your thoughts?
I'm with you. I hope that it's low. I don't know how low it is. I think it will absolutely happen again, because if you put your hand on the stove and you don't get burned, what's going to keep you from putting your hand back on the stove? The biggest thing, the biggest issue that we have that came from this was crazy, Jeb. So I started thinking, from 2008 to 2012, primarily flipped homes. I still had my database. I would do some loans for clients, but I wasn't actively seeking loans. Well, when stimulus comes in, rates drop really low. We're like, well, this is kind of dumb. There's a lot of people out there that want loans, and I'm fairly good at doing loans. I should do that. And so you're sitting there, and at the time, we're sitting here going, oh, this wave will come to an end. I mean, 4.5. We've got everyone refinanced somewhere between 3.75 and 4.5. And if you had told anyone at that time, like, hold my beer, you've seen nothing. And not only have you seen nothing, within 7 years, the Fed will come in far more aggressively and drop rates well below where we are right now, everyone would have said you're absolutely insane. So from today, looking out the front windshield of our car, you're going, no, that's all behind us. That's
what kind of car are we driving? I'm more interested in that. What are we driving right now?
You have a Tesla, my friend.
No, but what we do in this, we're in, we're dreaming. What kind of car are we driving?
I'm not dreaming. I'm just dealing with moving down the road forward. So do I see it coming in the foreseeable future? No. What we're talking about right now is we're going to get inflation under control. So it seems inconceivable that they would do that. And what I would say, that hopefully the government has learned their lesson. They have made, we pay lip service to income inequality, to wealth inequality, not just income, just inequality, period. And what have we done? We made it worse. The people that owned assets, those asset values were inflated by low cost financing. So those that have more. Those that don't are sitting here saying, now I can't even get into the house and participate in that. So it solved a problem. It created what I would almost consider bigger problems. So the answer is, I think they will do it, and probably sooner than we would expect, just depending on what next crisis comes down the line. But hopefully they've learned and will moderate it and do less for shorter, instead of what we did in COVID, which was too much for too long.
There you go. Luis says, South Florida houses, even with these rates, seem to be holding extremely strong. What do you think? So here's the thing. I think what you're seeing now with rates isn't actually reflected in the market yet. It's not reflected in the data yet. It's going to take a couple of months for rates staying higher to see how they're actually impacting the market. Now, with that said, does that mean South Florida can't stay strong? No, it doesn't mean that at all. It just means, I don't think we've seen, so don't look at the data now thinking this is the data of what the market's going to do for the rest of the year. I mean, 30 days ago, 45 days ago, there were news articles everywhere talking about the housing bottoming because rates had dropped and demand had spurred, almost immediately with that drop in rates. Well, guess what? Rates went back up. So now the narrative has changed, and it's, the bottom is not here yet, so on and so forth. So just, again, buy when it's the right time in your life, and not worry about the headline, so to speak.
Jeb,
Yeah, go ahead.
We've got another comment here, and it kind of relates back to what we were talking about, and it's hard for people to get into the market. So Esmeralda says, I'm just about to close on a brand new manufactured home. Sigh, I wish it was stick built. True. Most people would prefer a stick-built home versus a manufactured home, but you've made the decision that owning your home is more important than having the exact home that you want. And one of the reasons why we talk about the difference between CPI and PCE, and why PCE is the Fed's preferred measure, is because they take into account something called the substitution effect. If the price of bread gets too high, then people will buy less bread and they'll eat something else. They'll continue substituting. So in this instance, we may see things like manufactured homes get more expensive relative to single family homes, as more people who would prefer a stick-built home end up buying manufactured homes. And we're seeing a lot of this. People are changing their behaviors, buying patterns. We had a comment, Jeb, a month or two ago. Someone goes, oh, 650,000, you must be looking in Compton. We're like, good luck, brother, because Compton ain't $650,000 and hasn't been for a while. But we have people. How do homes in Compton get to $750,000 or $800,000? People that make pretty darn good money have decided, I can't live in Ladera Heights, so I'll live in Compton. So that's what you see. They're substituting neighborhoods. They're substituting types of properties. And it's a tough decision in terms of buy, not buy. If you're going to rent, how do you overcome some of the advantages that those that own homes have? Jeb, we're going to do an episode of the podcast, just like, okay, if you don't buy now, is there ever going to be a better time? And that's not, listen, we're not saying now is the best time. We're saying, is there going to be a better time? And what would have to happen for there to be a better time for you to enter in? Because really, the whole purpose of the show here is the educated home buyer. I think, Jeb thinks, over a lifetime, everyone should be a homeowner. But it doesn't mean you should always buy right now. It's helping you make the best decision for you of when the time is to become a homeowner.
Good stuff. Alvin says, what do I do to upgrade my house to get a higher value? For example, kitchen or putting a pool at the backyard. I live in California. So here's the thing. What you need for your house to go up in value is for your neighbor's houses to go up in value. For one, that's really a big part of it. But, do you get dollar for dollar what you put into a house with regards to adding value? And the answer is no. If you do a $50,000 kitchen remodel, your house isn't automatically worth $50,000 more. Maybe it's worth $5,000, $10,000 more. But it really comes down to comparing your property to another property that has sold in order to increase that value. So yes, things like kitchens, things like bathrooms, they add value to your property. Now,
do they add 100% of the expense of doing it, Jeb?
Do they? Is that what
do they? If I spend $40,000 on a new kitchen, is my house worth $40,000 more?
No. Were you there when I talked about that? Or were you moonlighting over there a moment ago when I said that?
I was trying to research some data here. So we
have so Josh was moonlighting on my answer to the question. But no, exactly. So, a $50,000 kitchen, like we said, might add $5,000, $10,000 to the value of your home. Pools are one of those things that a lot of people are misinformed about, because pools are expensive. $75,000, $100,000, addition to do a pool. Sometimes many, 2-3 times over that, depending on what you're doing to the backyard. You don't get that back in value. You do these things because you want to enjoy them yourself. So that's part of the reason that you do, the pool or the upgrades, is because you want to enjoy them. Are they going to make your property worth more? Sure. But again, it's not going to be dollar for dollar. So look at what homes around you are selling for compared to your home that have the nice kitchen, that have the pool in the backyard. And you can get an idea of, if you did that to your house, what your house would likely be worth in that environment. Now, again, it's going to be hard to compare it apples to apples without having a realtor kind of guide you through that, but give you a really good idea. Hopefully that's helpful.
And Jeb, I think the question behind that question was, hey, I want to invest in my home and make it worth more. There's better ways to invest that money. It just, you're not going to, unless you have a distressed property where the kitchen is awful, then putting a nice kitchen in it probably would get more than a dollar for dollar improvement out of that. But for most of the things, if you have a middle of the road 20-year-old bathroom or kitchen, it's going to cost more to replace it than it is going to give you value back out of it.
Yeah, but no, I mean, my wife and I always talk because, we're always talking about doing different things to the house, and we got unfinished projects and all those different things. And it's funny because when I walk into somebody's house that has some outdated things and they're getting ready to sell it, they're willing to do all of these things to sell the house. They're really willing to do kitchens and bathrooms and paint and redo the roof and all of this stuff, but they never enjoy it. They never get to the opportunity to enjoy it. They're just doing the improvements so that they can get more money for the house. Our whole thing is do the improvements while you're there so that you can actually enjoy the new kitchen, enjoy the fact that you have a pool in the backyard, and at the end of the day, it's going to net you more money. It's just hard to say how much without knowing the market that you're selling in, what homes around you are selling for, and all that good stuff. But hopefully that's helpful. Josh, what is a DSCR loan? We talked about this a couple weeks ago. Debt service coverage ratio is what the acronym abbreviation is there. What is it? Can you use it in California?
You can use it anywhere. There's literally lenders doing debt service coverage ratio loans everywhere throughout the country. The thing is, you cannot use it to buy an owner occupied property. We can't say, hey, if I had to, I could rent it for $3,000 a month, because that's what it is. Basically, whatever the rents are, you have to have a coverage ratio of the payment. Sometimes it's one to one. So if you have a $3,000 rent, market rent, you can have a $3,000 payment. Some will let you go beyond that. They start getting more restrictive. The terms get even worse. Most of them want it to be less than what the rents are. They would like your mortgage payment to be less than what the rent is. But it's an investment property loan that says, I'm going to buy a home as an investment that's going to generate rent. And rather than me showing my ability to repay, the property is showing its ability to repay. So unfortunately, it's not going to work for anyone doing owner occupied, but you could do it pretty much anywhere in the country. Not all lenders do them everywhere, but there are lenders doing them everywhere.
Awesome. So been on the show about an hour tonight. I'd like to ask a favor. If you're finding any value in the show at all, if you find any value in Josh and I taking our time to help you guys, do me a favor and hit that thumbs up. If you haven't done so already, maybe you're not aware, we do have a podcast called The Educated Homebuyer. Every Tuesday, we post an episode completely separate than anything that's posted on this channel that talks directly about educating homebuyers. This past week, we talked about down payment, everything around down payment. Where does it come from? How do you get it if you don't have it? All of that good stuff, right? So 30 minutes or so of that episode. And each week we do a different topic. So go check that out. You can find it on the Educated Homebuyer podcast. And then on Friday, we take this episode that we're recording at the moment, and we take the audio from it and put it on the podcast so that you can listen to it in audio form if you so choose. And so hopefully you're finding value in that. I know a lot of you guys are reaching out, thanking us, so we appreciate the support there. There also is a YouTube channel for The Educated Homebuyer if you want to watch the videos versus watching or listening to the audio. So you can find that by searching The Educated Homebuyer out there. So if you're going to do that, subscribe to that channel as well. Josh, anything else you want to add before we get?
I have a special request in relation to the other YouTube channel. I was looking at our demographics here, and the demographics of the Educated Homebuyer YouTube channel is 88.5% male. Yet I look here, I see Kim Smith, I see Gloria T, I see Dina Maston, Anya, we have Esmeralda. We have lots of women here asking lots of great questions, but apparently they don't like watching us on YouTube. We truly have faces for podcasts. They like listening to us.
But, there you go. That all works. That all works. Doesn't matter how you get the info, as long as you get the info. All right. Question. Kim has a really good question. Something I talk about all the time. Says, if you see a property on Zillow and it shows one picture and it's not so appealing, is that a bad sign? The answer is an absolute resounding yes. That is a horrible sign. If you only see one picture on any platform, and you can usually look at the picture and then you could read the description and you can get a really good idea of what that property is offering. Usually one picture means it needs a lot of love. There's nothing more to show than that front picture. Not always, not 100% of the time. So just understand, take my comment with a grain of salt, but it is usually an indicator of a home needing a lot of work.
Is it always that, or is it sometimes a lazy realtor?
Could be that. Could be a lazy realtor. I would find it very difficult if I were a seller and I hired you as my realtor and you posted one shitty picture of the front of the house. Like, I would understand if my house was awful inside and I'm like, hey, dude, this is
I'm a hoarder.
best.
Don't show the inside of my
I
house.
understand what you're doing here. You did me a favor by not showing the rest of the house. But if I have a beautiful house, I want you to show it. So there would be a problem there. So I'm going to go out and say it's not a lazy realtor. It's a realtor doing their buyer a favor, or their seller a favor, rather, by not showing the home. How's that? Right. Josh, we have good questions tonight. Dina has a question: the difference between a loan modification versus refinancing. So this is a pretty easy one to address.
So refinancing, you are replacing that loan. You are with a current lender and a current servicer. You're getting a new lender to make a new loan to you and replace that loan. With a modification, you're going back to the lender and saying, hey, I've got issues. I got problems. Not always. I'll give you a specific instance when it's not problems. But in general, we're saying, hey, I can't make my payment as is. Will you help me out? Can we do this? A specific type of modification that we talk about on the show occasionally is a recast. If you make a large principal reduction, you can go back to your servicer. So in the current market, let's say you have a 3% 30-year fixed for $500,000. You inherit $250,000 from Aunt Sue. You don't know where to invest it. You pay your mortgage down to $250,000. Well, your payment doesn't go down on a fixed rate mortgage. It would on an adjustable, but not on a fixed. You can go back to the lender and ask for a recast. Well, technically that's a modification. They're keeping your loan in place. They're drawing up a modification agreement and saying, here's a new payment schedule. But what happened in the last downturn, people were underwater and they went back to lenders and said, hey, I'm underwater. I'd like to stay here. I'd like to make payments. Would you rather go through the expense of foreclosing on me, reselling my home and hoping you get more for it? Or would you rather say, hey, I owe you $400,000. Let's write it down to $300,000 and go from 6% to 4% interest and make a more manageable payment. And that happened some. It did not happen a lot. If we ever get into a similar market, I think lenders learned that they took more severe losses by not cooperating with loan mods, and we would see more of them in any future downturn.
Good stuff. Orange Pulp has probably the best comment of the night. Says one pick rule also applies to dating sites. Very true. If there's only one picture on the dating profile, you probably want to stay away. Another easy question here. Darren says, I have a 4-bedroom, 1-bath house. Do you guys think adding a half bath would increase my home's value dollar for dollar, or would this be the case where I spend 15 to add 10K? No, I think in those circumstances where you're adding a bathroom, that would increase your value more than probably. It depends. I mean, again, if you're spending $50,000 to build a bathroom, maybe not. But if it's costing you $10,000 to $15,000 to build it, I think that probably reflects in your value. But the easy way to compare is find your market, find 4 2-bedroom, 2-bath homes with comparable square footage, find out what they're selling for. And then you can get a really good idea. Okay, my house is worth this, that house is worth that. Am I getting the value? But here's one of the things that I mentioned a moment ago. By adding that second bathroom, chances are it's going to improve your life. So it's not just a dollar for dollar upgrade or add in value that you're getting. It's a life upgrade by having a second bathroom, in my opinion. So just something
Jeb,
to keep in mind. Yep.
What I would say, from having flipped a ton of houses, a thing that comes into it, the cost, like you mentioned, is probably the most important, but then also what does it do to the floor plan? Some 4-bedroom, 1-bath homes have a perfect location for an extra half bath or a 3/4 bath. Some of them you would throw off the whole flow of the house and it may not get you that back, but hopefully there's somewhere logically for it to go in the house and you can keep it at a reasonable cost, because most people, it's especially with 4 bedrooms, you're assuming you have a number of people living in that house. It's tough to live with 1 bathroom. Jeb, could you guys with 19 kids live with 1 bathroom?
No chance. Well, it's funny, probably because we're all in the same room all the time. Like we could live in a
the same bathroom. You could just go in the same bathroom.
Dude, it doesn't. When somebody's showering, everybody's in the room for some reason. I don't know. Like they have a nice bathroom. They choose to use our shower. everything. We talk about it all the time. It's like, why do we need a bigger house? We're always within like 300 square feet of each other. So, but for bathrooms, people do things in bathrooms. You just don't want to go behind them. And it's nice to have additional bathrooms, if you know what I mean. Anya has a question about China. And then we have another one here. It says, what do you think about China's foreclosure crisis? And then we have Robert coming in saying, supposedly there is trouble looming in the housing market in China. Would that domino affect the U.S. prices since China, U.S. is interconnected? I say no, just because China has been doing crazy stuff with housing for years. I mean, they have entire cities that are unoccupied, that built and nobody's ever lived in. And I think China has a way of falsifying information, not providing information in order to save face and what have you. So, does it come over here? I don't know how it would affect here because U.S. housing market, U.S. citizens aren't invested in the housing market in China, if you will. Whereas you have a lot of Chinese that are invested in the U.S. housing market. So if something happens here, that could affect the net worth of those individuals, but I don't think it goes the other direction. Josh?
I would say paradoxically, it would be a good thing for us in the United States in the sense that when the Chinese economy is firing on all cylinders, manufacturing is at peak levels, construction is at peak levels. They are using a lot of natural resources and causing global natural resource inflation. We're, again, hoping to get inflation under control here. So no one's building when you have a foreclosure crisis or a property crisis. Like Jeb said, it's really hard to read into the books, and their industry there, a lot of this is financed with government debt or companies that are quasi-private but really financed by the government. So it's hard to read in too much to it. But if they had a property crash and it negatively impacted their economy, it would, to me, be a positive for us here.
All right. Essa?
This is the question of the night, Jeb.
No, it's a great question. It says, for the self-sufficiency test, are the rents calculated at market rent or the current tenant rent? This is California FHA loan for a quadplex. So I'm going to give some background here. Josh, you can answer the question, okay? Unless you wanted to give it all and just explain what self-sufficiency is. Why don't you just go ahead and handle the whole thing? So let me start by saying, what is self-sufficiency when it comes to FHA?
So the reason why I say this is the question of the night is I get people calling me all the time. They want to buy their first home. They're in Southern California, a high price market. And to mitigate that, they want to buy a 3-unit, a 4-unit building. FHA has a little known test called the self-sufficiency test that Esau here is aware of. And what that means is that, let's call it a fourplex. All 4 units, the rents from those 4 units, despite the fact FHA is owner occupied, you have to live in one of them. We take the market rents, not the current rents. We take the market rents and multiply them by 75%. That 25% haircut allows for a vacancy and expense factor, and your mortgage must be less than 75% of the rents from all of the units. In high-priced areas like Southern California, like the Bay Area, like many other parts around the country, it is almost impossible to get a house, a 3 to 4 unit building, to pass the FHA self-sufficiency test. So the good news, Esau, you get to use market rents. The market rents are defined by the appraiser. You're going to do a market rent survey. They're probably not going to actually get you the real market rents. We talked about earlier in the show, rents are moderating, but still sky high. You're going to go, bro, how are you seriously telling me that's what my market rents are when I can't go in that neighborhood and rent one of those for that price? You're going to get a number that's below what you would be able to rent for in the area, but better than the rents that you're getting on the property. It's going to be really, really difficult. Now, for those of you who are not playing here in California, good news for you. I've got a buddy in Minnesota. He does 2 or 3 of these a month, every month, helping millennials getting into 3 and 4 unit FHA, 3.5% down, because the rents are lower than California, but they're higher relative to the purchase prices.
Good stuff. I'm just glad I have on pants because I got up and walked away, and that would have been really embarrassing, Josh, had I stood up and not had pants.
Most weeks Jeb doesn't wear pants, so this is a shock and a surprise to all of us.
That would have been a surprise to everyone. Let's see here. I had a good question. I was going to click on it.
Darren said he actually lives alone in the 4-bedroom, 1-bath house, so he really doesn't care. But he thought it might be beneficial.
Like you said, though, it's a lot of bedrooms, 1 bath. I think resale, most people are looking for 2 baths. So I think for resale, it adds value, but it also gives you a larger pool of buyers to choose from when looking for properties. right? Because there's just less people willing to take a one bath. Once you have that second bath, you open your pool of buyers. If you had maybe 10, now maybe you have 20, 30, 100 because you have a second bathroom.
My flipping brain, and also being that you're living in the property, says, are there two of those bedrooms that can logically be combined and build a master suite in there with that? And Jeb may say, never, ever, ever give up a bedroom. But a lot of times
I think that's okay.
Especially a 4-in-1, a lot of times those bedrooms are small and you don't have a true master. It can be, we're not allowed to call them masters. What are they called, Jeb? Primaries. It's a primary bedroom. So I apologize.
I refuse to go with the new lingo, so I still say master.
Okay. Well, primary master, most people want that. They want a bigger room with an attached ensuite bathroom
from this.
So if you can do that, and so you have the full hall bath, and now you have a master primary bedroom. It's old habits die hard here, Jeb.
It's really amazing how one person perceives a word and it changes the whole dynamic of the word.
I had never heard of anyone being offended by it before we were told we're not allowed to use it anymore. I can understand the logic of someone saying, hey, that's what this came from.
Yeah, I get it now. Like, I understand where it came from, but if you're not offended by it, like, what is it? Like, I don't know. We could go down a rabbit hole. We should start a podcast like that.
Questions with no answer.
We could go down a rabbit hole. Question from Carly says, how do comps work for a 3,000 square foot house in a very small town of 12 to 1,700 square foot homes? Maybe a few others are comparable in size, but no recent sales. Part of that, they'll adjust for square footage, on a price per square foot basis. So that's part of it. Ideally, they want to find properties that have sold. Maybe there are no 3,000 square foot homes that have sold in the last 3 months, 6 months. They'll go a little bit further out and find one that did sell. Maybe it's a little bit longer time frame and do a time adjustment on it as well. It's hard to say because each little market's a little bit different, and how lenders and appraisers will look at them a little bit different and what they want to see in an appraisal. But there's ways to adjust, and it really comes down to, making that square footage adjustment or finding something that has, sold in the past and making that adjustment. Be a good question for an appraiser, honestly, to see how they do it. But I would think maybe those are two of the things they would have said. I don't know. Another question coming up along, having bigger properties. How do I make a decision? Should I add to my house to make it bigger, love the location, or should I move to a bigger house, but not the ideal location in East OC? I always say live where you want to live. If you love your location, add on to that property. It's usually less expensive to add on to your property than it is to go out and find a property that is larger in size. And there's two things here. One is usually you're paying for a more expensive property in most cases to do that. Now, some cases, depending on what you're adding on, it might cost more than it does to go find that, but you're saving on your property taxes too. So if you bought a house that you've been in for any significant period of time, your property taxes are also going to be based off when you bought that house. And so by buying a new house, your property tax is going to be based off the new amount. And therefore you're paying more unless, again, you're, taking prop 60, 90, 19, whatever prop you're using here in California. You're not taking the full basis, but that's a whole different question. So I think it's better to stay in the location and add on if you can do it, and really love the location that you're in.
Well, I'm assuming that the viewer is in Orange County, so this might not be the ideal location in Orange County. Lowest price home you're going to have in Orange County, $750,000, $800,000. Say it's $700,000. 5% selling cost, which would be on the low end between commissions, everything. It's $35,000. That gets you half of the way, a third of the way to a fairly nice addition. So from that perspective, I definitely think you're in a better spot with that. And I would much rather add on than move to a subpar location or a less than ideal location.
There you go. I mean, we've got Eric saying the only thing that is more sexual than real estate is computer science.
They're both pretty spicy. They're both pretty spicy topics. Jeb is a computer science major, so that should tell you
that sells real estate. So just
real estate. Exponential increase in his potency.
Wow, you guys are pheromones are going crazy over here.
We can't get these people's minds out of the gutter. Kim
I
says,
know.
I'm not looking for anything with one bathroom, not when it's 2 men and myself. She shares a home with 2 men. Hopefully it's a 3-bedroom.
Maybe
so
it's her
everyone has
son, dude.
privacy.
Maybe she has a son that lives
Either
with
way,
her that
I
she's
hope
calling a
everyone has
man.
their own room and privacy,
Oh my
including the
goodness.
bathroom.
Where are you going with this whole thing, Josh? Let's see. What's a smarter use of lender credits that you have available right now? So Josh, you have lender credits. Is the smarter move to buy down the rate? Is it to pay for closing costs? Is it to do both? What would you recommend? I know it's hard to say without.
It's hard to say, period. If we had all of the information, there's not an easy answer. If you believe that rates are going to be lower in the future, I would not pay for a permanent rate buy down. For the most part, if you want to buy your rate down 0.5%, it costs 2 points. Ask anyone in November who paid 2 points that they could have, done that for free in January if they were happy about that. Now, again, we're a month later and we're all somewhere in the ballpark of where we were in November. It's hard to say. So we've talked about this before. A temporary buy down, that money goes into an escrow account, and anything that isn't used with your monthly buy down payments, when you get to the point that you have the opportunity to refinance, can come back to you. Paying closing costs eliminates the cost of that mortgage, frees up money to refinance later on if rates are going to go down. The permanent buy down, I would only do if you felt like rates are going to stay at this level or higher for the foreseeable future, and you're not going to have much of an opportunity to refinance. Your break-even period on paying points, lenders are very smart. You have one loan and you can say, I know what's going to happen with me over the next 5, 6, 7 years, but things change when it's one person. Lenders know when there's 20,000 mortgages in a pool pretty clearly on average what those 20,000 people are going to do. So when they price buy downs, permanent buy downs, they're priced pretty accurately because on average, it's going to be a 5.5, 6.5 year break even. So to them, we do 1,000 buy downs out of 50,000 loans in this pool. At the end of the day, it's all going to even out and we're going to break even. But for you, if you're going to pay for a permanent buy down, you need to make sure you're going to be there for a while and you're not going to have the opportunity to refinance, which requires a crystal ball, which I believe rates will be lower in the next 2, 3, 5 years. And there will be a refinance window from this, but obviously there is no guarantee with that.
I love it. Anya is telling me to take my own advice and add an addition versus buying a house. And this is something that we've talked about. The problem is the addition that we would add on to our house doesn't add enough square footage to really, for the cost of what it costs to add on.
Can you do a 2-story addition in that section? You can,
but it puts the master bedroom in a weird, like, you're going to have a room off your mat. Like what it creates a weird, what I think is a weird addition. I don't know. So we've thought about it. Is it something we'll do? Maybe. It's like, we love the location of where we are, but I don't see us being in that property forever. And so, what I know would happen is as soon as we started the addition or we're halfway through it, the right property would pop up and you'd be like, why did I do that addition? So just kind of seeing what happens here with inventory over the next, little bit and make a decision from there. But I like you giving me my own advice. I appreciate that.
Kim clarified it is an above board situation, just her husband and son.
There you go. There you go.
No crazy lifestyles around here.
Here we go. Andrea says, I'm a first-time home buyer in Iowa, meeting with lenders in the next coming weeks. Are there specific questions I should be asking as it relates to the current market? So when talking to a lender, I think it's less about the current market so much. The lender isn't really giving you an update on the market, I wouldn't think. I mean, maybe if you're talking to Josh and you ask the question of the market, he might give it to you. But most lenders are, trying to help you with your financing or what have you. Josh, what questions do you think are important for someone to ask you?
Well, when I read that question saying current market, maybe she's thinking in terms of that last question. Hey, if I get points from the seller, a credit from the seller, what should I apply it to? How do I use it in the current market? What's ideal for me? What do you expect coming down the line in 6 to 12 months?
Is that an interview question? Or not?
It can be because if you're talking to someone and they have no, not just an opinion, everyone has an opinion. If they don't have an educated and informed opinion, it can tell you why they believe what they believe. It can separate options. So what I would say, Jeb, the first thing that she should do is fill out the link and get connected with one of our preferred experts. Because what I can say is I get a lot of people reach out, Jeb, after the fact. They're a week or two away from closing. Things didn't go the way they wanted it to. They were told one thing and it's this. Or like I said the other week, I get people asking me questions all the way along the process of doing a loan with someone that was not me or someone that we recommended. And again, I'm not saying that I'm the only person or the people in our network are the only good ones, but I would absolutely include one of those people in your interview process because they should be able to give you a feel. I'm not going to tell you the same things about the market as Jeb is, because his job is to give you value, location, school districts, that type of stuff. My job is to tell you money wise, what does this loan do over the long haul relative to this one? If we have a lender credit or a seller credit, what does that do for us? How does that change it? So hopefully it's someone that's taking the time to walk through everything with you and educate you on your options. And you get the feeling like, Jeb, we've talked about this probably 3 weeks in a row now. Don't just make your decision on terms. They should absolutely have good terms, but don't go with someone that has the lowest terms. Go with someone who has good terms, someone who you have a good rapport with, that listens to you, hears you, and answers you, and that you feel has knowledge and expertise. So when you're going through that interview process, make sure the person that you're deciding to work with in the long run checks all 3 of those boxes.
Yeah. And you want to ask the questions, how long have you been in the business? Who am I working with in this transaction? Maybe, after you take the loan application or what, who am I talking to? Who's going to update me? Are you going to be available to answer my calls? Do you text, call, email, that sort of thing? Do you work on the weekends? I mean, these are all things that I don't know that need to be a certain answer for every single one of them, but it's things that you should know and be able to compare people kind of across the board. In addition to just getting a feel for people. I feel like you can tell in having conversations whether somebody, is engaged, wants to have that conversation, is there for you, and wants to help and all of that. Right. So, use a little bit of the feel as part of it as well. But get a referral, start with a referral, whether it's from a friend, family member, someone who's been through the process recently, from the link that's scrolling the bottom, however, and just compare a couple of people and go from there, and you'll be in good shape. We answered that already. Josh, this is a good question. I have a VA loan on both of my properties. If rate drops, can I refinance both properties to a conventional loan to free my VA? First house has $400,000 equity, and second house was purchased last August. As a second home, I use my remaining VA eligibility. I'm unsure if there's equity since it was both last August. So bottom line is, can you refinance a VA loan into a conventional loan to free up the entitlement there for VA?
Absolutely. It's a standard loan. There's no prepayment penalty with it. You can pay it off at any time. One of the cool things that you brought up here, if there's any other veterans watching, many veterans think that if I've used my VA loan entitlement, I cannot use it again without paying off or restoring that. That may be the case. If you bought an expensive home that required all of your entitlement for your guarantee, you may not be able to buy another one, or you may need to put a down payment. But some folks in lower priced areas are able to get 2 loans with no down. It sounds like you may have fallen into that bucket. So there's a secondary part of your question. Can I go from a VA to a conventional? Absolutely can go from a VA to a conventional. But you asked under an LLC. Fannie Mae, Freddie Mac make the vast majority of conventional loans. They will not lend to an LLC. We've also talked about this previously on the show. There's nothing preventing you from changing title from yourself as an individual under the LLC after you get the loan. But if you ever want to refinance again in the future, you're going to have to take it back out of that LLC, because Fannie and Freddie will not loan to entities. They will only loan to individuals or revocable trusts.
Revocable or revocable?
You can pronounce it either way. It's sort of like tomato, Jeb.
I've never heard anybody say that. I was just clarifying. I'm from North Carolina, so we say things weird.
You say lots of things weird. Most of the time, we don't know half the things you're saying.
We say pecans. You probably say pecans or something like that. That's weird. Just saying. ZL has a question. It says, if underwriters follow My throat is getting itchy,
You
guys.
want me,
Sorry.
want me to take it? I'll just show. If underwriters follow the same guidelines, then why was I approved from one lender and denied at another? Reason was too many open cards in 2022. So you can open 9,000 cards. There is no loan program that says that guy has 9,000 cards. We cannot approve him for the loan. It can impact your credit score. And a lender may have an overlay where they don't lend to people with that credit score, where another lender doesn't have that overlay. That can be the issue. You can be dealing with someone that is not interpreting the guidelines correctly. So either one lender to the next. An example, we're just talking about VA loans. The biggest VA lender in the country, who bombards veterans all over the internet with ads, they will not do a loan with over a 45% debt to income ratio. You can go as high as a 70 something percent debt to income ratio in certain circumstances under a VA. So they will tell you, oh, you don't qualify, you don't meet the guidelines. And then you call an independent mortgage broker like myself, we go, no problem, you're approved. So it can be an overlay where they literally have a policy that says, we won't do that loan, even though Fannie, Freddie, FHA, VA, USDA will. Or you may be talking to someone who's just ignorant and doesn't know how to structure the loan or how to ask you the questions to get super clear on your situation to make sure that you do get qualified.
All right, good stuff. Kim has a question, says, when buying a condo, can you change things inside, remodel? The answer is yes. Typically speaking, anything done inside a condo doesn't usually need HOA approval. You might need building permits from the city, but typically you can do that without having any sort of approval. Now, I know there's condos in different markets and different guidelines and CCNRs and all of that good stuff that may require some sort of HOA approval for the inside, but typically speaking, you should be good to go.
So Jeb, let me give you my experience on that. We have a condominium in Rancho Mirage. We bought it. It was glorious 1974 original condition. And we redid the entire thing, moved walls, all that fun stuff. So for those of you who may know, if you're from Southern California, in terms of desert communities, Rancho Mirage is the older people desert communities. So all of the people on our condo board are like 80-year-old retired contractors who know all of the guidelines for contracting in the 1970s and 80s and nothing about current guidelines. So they were telling our contractor, our engineer, and the people at the city who had approved our changes that they didn't know what they were doing. So for us, that situation, because we were doing things structurally and not just, paint, carpet, new cabinets, that type of stuff, it was an issue with them. They had to approve our plans, but we got to do whatever we want once we proved to them that they didn't know what the building codes were.
All right, Josh, Kim has a question about podcast episode that talks about debt to income ratio. So can you pull that up there when you get a second? We'll find the answer for you there on that one, Kim. Flight simulation experience says, we've seen price appreciation across the country that is unprecedented since the pandemic. Please make the case why, or why, if the housing, or why it will or will not, I assume the housing market will crash. So I don't see any world in which the housing market will crash. And it goes, there's a number of reasons here. One is it's built on a completely different foundation than 2008. You still have low supply in most markets out there. I think what I showed earlier says you have 429,000 homes across the US at the moment. Condos, single family townhomes, right? So no inventory, buyer demand is still there. So in the current environment, even with rates high, a lot of markets out there are still receiving multiple offers. So you still have a supply and demand imbalance, even though there's new construction coming to the market, later in the year, 5.5 months of supply, so on and so forth. You're still 4 or 5 million homes short of what you need to have to be able to keep up with the growing demand. So you have a lack of supply. You have many sellers out there sitting on super low interest rates. So let me back up. One thing you need for a crash to happen is you need a flood of sellers to come to the market. You need supply. You need excess supply. The reason you're not going to have excess supply anytime soon is because, again, appreciation, right? A lot of these sellers have appreciation, but what people are thinking about is last time you had distressed sales last time. In order for a lot of excess supply to come to the market at one time, you need a lot of distressed sales to happen. That's not the environment we're in, right? Because last time you had rates adjusting because people were on 2 and 3 year loans. rates were adjusting from interest-only payments, sometimes negatively amortized payments, to fully indexed payments at much higher rates. Most people today have 30-year fixed loans. Now, with that said, there are people recently getting 5-year, 7-year adjustable rates, but they're not interest only for the most part. Most of them aren't. I don't even know that you can do a 2 or 3-year adjustable anymore. So you have longer fixed rate loans for one. You got record equity in properties. You've got people, again, locking in 30-year fixed rates. You've got appreciation. You have a lack of supply. You got foreclosure sitting at record low levels. There's not a recipe. Now, typically speaking, when somebody asks this question, the reason they ask this question, and again, I'm not saying this is you, but it's because people are priced out of the market, because they don't agree with where prices are going, because they can't afford it. It has to crash. And so that's not a recipe for needing a crash. The things that we talked about a moment ago are why crashes happen. And at the moment, we don't have any of those indicators that says a crash it needs to happen, right? We've seen home prices pull back. Normal. We've talked about this for a year and a half. You're going to see home prices pull back because we saw 30, 40% appreciation in some markets out there. When what would normally happen over that 2-year period is maybe 8%, maybe 9% on the high side. You saw 40. That's not normal. So you have to have some pullbacks in prices, again, for wages to catch up, for, just affordability to kind of catch up and get back closer to that trend. So Josh, that was a long way of answering the question. But I know you have some things to add to it.
Agree with everything you said. Obviously, we talk a lot. We're on the same page with this. But the question, or what happens over the long haul, everything will experience mean reversion. So the point that you made is indisputable. When we say on a nationwide basis, what is it, Jeb? Like 4.8, 4.9% over the last 70 years, historical annual appreciation?
Yeah, 4.7 or something like that.
4.7, somewhere in that range. We just came off of a 3-year period where most areas are somewhere between 30 and 50%. So you get that in 3 years when we should have got 16 or 17%. What has to happen going forward? People say, well, it means it has to crash. It has to have this huge drop. It does not, for all of the reasons that Jeb listed. It does need to correct, and it does need to revert to that mean. So my expectation would be for the foreseeable future, it wouldn't be reasonable to expect not just those outsized gains of 15, 20%. It might not be reasonable to expect 5% appreciation. We could have 5 years where the market goes nowhere. And the reason why that is the greater probability for the mean, for the market to revert to the mean, is that we don't have this recipe. We don't have this forced selling. As Jeb said, people are sitting on record levels of nested equity at spectacularly low interest rates, and rents are very high. So they will beg, borrow, steal, fight, scratch, and claw to stay in their home. So someone has to be highly motivated to sell, which limits supply. Until we have a massive wave of forced selling of some sort, you don't have supply going up into a reduced level of demand that we have right now due to low affordability, primarily due to high interest rates in combination with the high home prices. So do I think the premise that there needs to be some mean reversion is accurate? I absolutely do. I don't think it's coming from a crash. I think it's from an extended period of below trend growth. Maybe there are some negative years, but it's not negative 15, negative 20%. It's negative 2, 3, 4% for 3 or 4 years. And that brings you back on trend. I'll try and do the chart next week, Jeb. If we project a linear trend over the housing market, we didn't get anywhere near as above trend in this last bump from COVID as we were into the craziness of 2006, 2007. So is it above trend? Absolutely.
We have that chart somewhere. I forget where it is. Yeah.
We'll pull it out next week because it's a great question. And I do expect mean reversion. I just don't expect it in the form of a crash.
A comment here and then a question. Both are good. Rickless Cage says, is that a Texas Tech hat helmet?
It is. Red Raiders.
People don't want to hear it, but the market will not crash like it did in 07, 08. Many people bought or refinanced at very low rates. Very, very true. David has a good question, though. It says, what is the probability of buyers who use rate buy downs falling into distress if interest rates do not significantly drop in the next couple of years? So some people out there are doing now. One thing to note, David, is that people buying houses are still qualified at that that higher rate, right? So they're not qualified on the lower buy down rate. So qualification wise, they still qualify for the home. Whereas back in '08, that wasn't the case in a lot of cases. You could qualify on the interest only payment. You could do crazy stuff back then. But Josh, what are your thoughts on interest rates not dropping, buyers not getting that, that opportunity to refinance, if you will, and payments going up? Are they then in distress and need to sell, or are we talking about something that's not likely to happen?
So David is obviously talking about temporary buy downs. A permanent buy down is never going to change in the future, so you don't have a problem. You take 2-point seller credit, you buy the rate down 0.5%, you're fine no matter what happens with rates. You take that 2 points and you pay for a 2-1 buy down, and you're 2% below the market for a year, and then 1% below the market, and then to market rate. You're at least still fixed. You're not exposed to, if the market rates were to increase, you don't have a potential for something you are unaware of, but you're certainly going to be getting used to something where the payment is massively higher in after the 24th payment. So from that perspective, could there be some distress? Yeah. But as you said, Jeb, everyone is qualifying at the note rate, not the start rate. It was one of the big things that got pushed through post 2008, in that we no longer will ever qualify someone off of best case scenario. We're generally going to qualify them off of worst case scenario.
All right. Good. Lynn says, some say we can't negotiate HOA fees. What's your experience with HOA? Do these fees only go up? How do we lower HOA fees if possible? I'm looking to buy a new construction home. So can you negotiate them? No, you cannot negotiate them. It is up to the board in your community to make the decisions on how much the HOA fees are. So why do HOA fees go up? Well, it's because the expenses, the cost to maintain that community typically go up over time. Inflation is part of it. Reserves, having to build reserves to be able to pay for the replacements of things like streets. And if it's a condo community, maybe they do roofs and paint, and maybe there's a pool and there's maintenance around the pool. And so, and landscaping and all of these things, right? So they're building reserves. So what can happen sometimes is the financials of that community are mismanaged for a number of reasons. People just not knowing what they're doing, overpaying, undercharging homeowners, and not building proper reserves, and therefore having to raise them substantially in order to get back on track. But typically HOA fees go up over time because of inflation, because the cost of things go up over time. Not 100%. I was on the board of an HOA. We reduced HOA fees 3 times, 3 years in a row. We reduced HOA fees. So it can happen where fees go down, but I would say it's more common that they stay the same or go up over time than they go down. But at the end of the day, you want to help the HOA fees go down, get on the board. That's really the answer. Not the one you want to hear, but it's the answer.
So is that your answer, Jeb? You got on the board, and so the HOA fees went down?
No, not at all. My community is very well managed. They denigrate everybody. It was already headed in that direction prior to me going on. I have nothing to do with it. But it's, if you want to make an impact, or I just wanted to know what the hell was going on. That's why I joined the board.
And I say that
it's a thankless job.
Jeb, I say that half joking. It is not an easy job. It's a time commitment, no pay other than, hey, we're going to hopefully get this better managed and have lower HOA dues. But I'll say the same thing. I've told you this before. The complex where you live in, Jeb, has many more amenities that require maintenance and upkeep than the condo complex where my sister and I inherited from my dad. And yet our HOA dues are higher. We did finally last year got a decrease. And the one and only reason for that is the residents there got pissed at the idiots that were elected to the board and doing stupid things, replaced them. And it took about 2 years. And they go, we have our budget under control. We have enough reserves. We have a plan for the next 10 years for everything that has to be done in this complex. And we went from like $535 to $489. So is it a huge difference? No, but $535 was absurd for the level of amenities we had. $489 is just on the high side, because that's still more than what you're paying, Jeb, and you have massively more amenities than what we have.
Yeah, significantly more. I'm looking for the episode on debt to income.
I went through the entire spreadsheet, Jeb. I don't think we've covered it. I think Kim came up with a spectacular idea for this week's episode.
Well, we have covered it though, but we've talked about
We've covered it, but not as a topic in and of itself, where someone could go to this and understand all the nuances of debt to income ratio, what's included, what isn't, and what is allowed in different programs. I think.
Well, where can we direct her to start? Because that would be a good place to.
There was nothing great in there.
Okay.
We probably covered it in terms of the one where we talk about so you don't qualify for as much as you want. What can you do to improve it? We probably discussed it in there.
Okay.
But I don't know that we've gone super in detail. There's probably 5-10 minute nuggets in several of the episodes, but not a full laid out end-to-end discussion.
Well, we suck. That's it. I mean, sorry.
Speak for yourself.
Can't help you. Okay. Well, I was going to try to find it for you, but it looks like Josh has told us that it doesn't happen. So we'll record one for you, Kim, and let you know when it's happening.
Nostradamus Jeb has entered the chat. So make sure John Rodriguez is called for a crash in early April. He didn't say what's going to crash, but there's going to be a crash in early April.
Ooh, I bet a car crash. I bet there's going to be a car crash on the 405.
We're going to timestamp this moment on March 1st. So in the next 45 days would be us in early April.
Dude, that dummy Robert Kiyosaki, bro, I see a headline that guy calls a crash like every 3 days. Eventually, that guy's going to be right.
Yeah.
Eventually.
Yep.
But it's not going to be on the housing. It's going to be on something else. What are we doing? It is 6:35, Josh. Time just flies when you're having the time of your life like us.
Kim has another easy question here. Are the Feds going to meet again this month? They never meet more than once a month. So they do have a March meeting. So March 21 to 22. Again, May, again, June, July, September, October, December.
I was thinking we were still in February.
They meet 10 times a year. And so we've got 1, 2, 3, 4, 5, 6. We got 7 more to go this year. And unfortunately, it looks like, Jeb, that May meeting is before we get our May CPI figures, which should have some good news.
There you go. There you go. If you don't think there's going to be a crash and there is a lack of supply and rates are planning to go up near term, then you think it's a great time to buy now or lock the appreciation. I don't necessarily think you're going to see a lot of appreciation, quite frankly. I think there's an opportunity for it to happen, but I also think there's an opportunity for it to go down a little bit as well. If rates go up and stay up, chances are prices are going to come down a little bit. If rates come back down, which I expect them to, that's going to put, more or less a floor in where prices can go unless you see a huge amount of sellers flood to the market. And I don't think that's going to happen unless you see rates go significantly lower, which I don't see a case for that happening anytime in the near future. So I don't think there's a rush to go out and buy a house. I think if you can find the right house now, the payment makes sense to you, money in the bank, longer term time horizon, great, go buy it. But I wouldn't be stressing like, hey, if I don't buy a house now, it's going to be worth significantly more tomorrow. I don't think that's the market we're in anymore.
Yeah, I understand the logic. There are some people out there that are not dumb that have outlined why they think it's a great time to buy real estate because of those reasons. I don't believe that. We go back to the question that we had a few minutes ago about the crash, and we talk about mean reversion. Because I do believe mean reversion is coming, not necessarily a crash, I don't think we're going to see some type of level of appreciation that people should be jumping in and buying real estate with both hands right now. It's just not that type of a tailwind market like we saw the last 2-3 years.
Agreed. I think the Fed meeting is actually the 22nd, not the 21st, but I might be wrong.
21st and 22nd.
Oh, there you go. All right. 21st and the 22nd. Josh, Kel would like to know, do we get a flashback pick or a video tonight?
Should we find one?
I don't know that there's anything worthy of putting out there, but
you've seen the best. We gave you the 2 best. We gave you the best picture and the best video.
There's some good stuff out there. We'll see what we can find. I don't know if it's going to happen tonight because we need to research it, but maybe next week. How's that? We've clearly gone off the deep end here because we're losing viewers by the second. What do we got here, Josh? Do we have any questions here? We don't really have a lot of questions.
Here's a question that cannot really be answered, but Lynn wants to know, not sure if you've answered this, but do you think rates will go above 8% in the next few months? Let's back into what has to happen. at the peak, the spread between mortgage rates and the 10-year treasury was 3%. So that would tell us we would have to have a 5% 10-year treasury. I don't expect that to happen, but if we're laying odds on it, is it a 0% chance? It's absolutely not a 0% chance. We would have to continue to see the big spread between 10 years and mortgages, and the 10-year would have to go to 5%. Don't expect it to happen, but it is not outside the realm of possibility.
All right, good stuff. We had one here pop up. Lowly tard.
Oh, that's not nice. You're not allowed to say that anymore. Your wife yelled at me.
Lowly tard. Am I crazy to buy a house that is pretty expensive, but with the knowledge that I am the start of my career as an engineer in the medical field? So again, I would say the same things. If you're comfortable with the payment now, chances are if you're at the start of your field or your career, chances are you're going to make more money over time. You're going to continue to be in a better position financially. So if it makes sense now, it could be a good opportunity, but it's to each his own. It's, buying a house is one of those things. It is a big step. Even if you're financially in a good position, it's one of those things that probably going to have a little bit of buyer's remorse, like as you're going through it, just because it's such a big thing to deal with. So just make sure you're comfortable with it and don't worry about all the other things. Again, if it's the right time in your life, right? If you're 18 asking this question, I don't know that that's the right time. But if you're starting your career mid to late 20s, thinking about family and all of that, then it's probably you're probably at the right point in your life.
And just let's talk about tailwinds. Educated, in an in-demand position, in an in-demand and growing field. So all of those things. I mean, there are certain industries that go up and down, ebb and flow. Like if you were a realtor or a mortgage broker, you got great years and you have lesser years. Your field is not like that. So if you feel like all the other dominoes are in place, I'd say go for it.
Good stuff. So what we're going to do here is we are once again going to ask that you hit the thumbs up if you found any value tonight. Also going to mention the podcast one more time. New episodes post on Tuesday, The Educated Homebuyer. Go check it out. This episode will come on Friday, but we're not getting a lot of questions, so my voice is scratchy. We're going to end it here. Josh, any final words?
I just want to know if the folks want to see the green screen videos that we used to do of Jeb's Market Update that had a set that looks like a dungeon, like you're keeping people in a basement dungeon.
Do you have that to show now?
I do.
Well, why not? This is going to be interesting, guys. Do you have the actual green screen?
I do. I do have both. Do you want? Is that what you're wanting? You're wanting to show both?
Show the edit. I mean, the edited version. These. When is the date? What is the date on this, Josh?
December of 2014.
Wow, guys, this is gonna be awful.
So we're gonna upload this video file.
Oh boy, we're sticking around. So I'll see if there's any other questions. So what are we doing? What are we doing here?
So here we go. We're doing it.
Happy New Year. I'm Jeb Smith, broker owner of Coastal Realty.
The audio sounds like you're in the dungeon as well.
There's Orange County. And more
the producer is awful here. He puts you in a dungeon and
oh god, that's enough. I can't do anymore. I can't do anymore. Look at that. Wearing a suit. This guy was trying to be a real estate agent.
Looking.
Dude, I was 34 there. Man, those are the good days. Those are good days. Newly married. Life was good. 2014.
John types in and says your videos are so informative, but he didn't say that until I posted this market update from 2014.
So that is clearly why he thinks so.
That was why he thought that.
That's good. Anyhow, we appreciate you guys watching. Always appreciate the support. Check out the podcast, subscribe to the channel here. Go check out the Educated Homebuyer podcast on YouTube as well. All those things lead us to education. Josh, I can't click the end broadcast here, so you're going to have to help me out. I'm stuck.
All right.
There we go.
You got it?
Yeah, we're good.